So let's just, instead of me talking logistics, because there's several people obviously who aren't here yet, let me just do what I always try to do, which is summarize what we've covered and what I can say what we're doing tonight and save what we're doing for Saturday. So in terms of the case book, just keep in mind that the majority of the exam questions, by the way, will be on the second half, but there's certainly, it would be foolish to forget things like 351 and the like. But Chapter 1, as you're going through it, is largely, hopefully, something that you can readily distill and understand now, more so than when you started. Don't worry about the alternative minimum tax. S corporations are a whole different course, but you should know what an S corporation is. Chapter 2 deals with our formation issues, and just like you saw and we'll see tonight, always look at the shareholder level. What are the consequences at the shareholder level versus the consequences at the corporate level? And different code sections are going to be operative depending on if the question pertains to the shareholder versus the questions that pertain at the corporate level. Sometimes not you guys get confused because there's a corporate shareholder, so you have two squares above two squares, but that shouldn't be a problem. I'll say tonight for the 18th or 100th time, the red carpet treatment is out here in Chapter 2. Everything is done to make it as tax-friendly as possible, right? When it comes to corporate formations, the glaring red carpet to make it, Congress wants to, and this is akin to other areas like partnership tax formation, Code Section 721. It's more restrictive in the corporate area. You have to have control, Code Section 368C. So it's not quite as easy as partnership tax, where there's no issue of control. Contribution of services, that's taxable, right? You contribute services at the time of formation, that's taxable. If you receive boot, right? The receipt of boot is taxable, but you guys know you can never recognize more than you realize, right? That just goes back to Tax 101. Capital structure. We have issues pertaining to what's equity, what's debt. There's often that's an easy question, but sometimes there is some blurring. And the second part of the chapter discusses what are the tax consequences upon the disposition of each, keeping in mind one code section in particular that students and practitioners often forget, Code Section 1244, right? That the disposition of capital stock can give rise to an ordinary loss treatment. So that does not always work. That taxpayers sometimes forget, and practitioners as well. Chapter 4, non-liquidating distributions, and this chapter had relevance for our midterm exam. This chapter has relevance for post-midterm exam. Why? Because Chapter 5, as we know, keeps coming back to non-liquidating distributions. And here, non-liquidating distributions, one of the first things we looked at, just like in Chapter 5, we had to look at Code Section 318 to know what is a redemption. Here we have to look at Code Section 312 and figure out the earnings and profits of a corporate enterprise. And then the other pivotal code section was Code Section 311, right? Because we know, at least in this context, non-liquidating distributions, that gains are recognized, losses disallowed, and that's universal, right? There's no special rules there. Gains recognized, losses disallowed. We talked about the constructed distributions, and notice we don't use the term dividends, right? Because distributions from a corporate enterprise may not be necessarily dividends, right? It depends on the earnings and profits of that company. And then we apply Code Section 301C1, 2, and 3 and figure out what are really the tax effects to the corporate enterprise. Towards the end of Chapter 4, guys, keep in mind there's some special rules that apply for corporations that are receiving dividends because we have Code Section 243. 243 is a very robust deduction, right? Comes in 3 different flavors, 70%, 80%, or 100% dividends received deduction. And when you have that kind of deduction, temptation lurks, right? And temptation lurks where taxpayers might play games or attempt to play games. So the second part of this, or the last part of Chapter 4, deals with trying to put the brakes on playing those games. Chapter 5 deals with redemptions. And we said globally in Chapter 5, we try to bifurcate this chapter into two, or look at this chapter and say, is it truly an exchange or is it back to Chapter 4? Is it merely a distribution? And our gatekeeper here was Code Section 302B, right? And we had to look at the shareholder level for B1, B2, and B3, right? The shareholder level. And then we applied 302B4 at the corporate level. But we know, I think we know, right, Shirley, that 302B4 doesn't apply to what kind of shareholders, Shirley? Corporate shareholders, right? And if there's 10 of you who want to stand up now and announce you're going to forget that for the final exam, you can make my job easier. But personally, again, I want to enjoy July and August. Don't forget it. It will make my summer that much more enjoyable. Unless you have something in you want to destroy your own summer and ruin my summer, just give me all the wrong answers you can. Okay, so Chapter 5, though, starts off with Code Section 318, the attribution rules, because when we try Code Sections 302, B1, B2, B3, we have to apply the attribution rules. We're instructed to do so. And we looked at the rules. We applied at the shareholder level. We applied at the corporate level. I had an issue. Janine, wherever you're hiding, came to my office to talk about some things, and a client asked me about you issuing preferred stock and what were the tax consequences. So corporate tax is alive and well. So we kept going through Chapter 5, and then the second part of Chapter 5 deals with the practical application. What are the by the way, one other thing before the practical application, what's the effect at the corporation of a redemption? And we said Code Section 311 once again applies. And what's the effects, where's Matt, on the earnings and profits, right? And that's Code Section 312N7, and there's a proportionate reduction, right, of the earnings and profits. And then redemption planning techniques. We have all these various planning techniques, because redemptions come up all the time, particularly in the context of buy-sell agreements, right? Buy-sell agreements that happen typically on death, retirement, and disability. Shares are often redeemed, and you get to test your knowledge of whether or not you know about redemptions. They may happen in the charitable context. They could also happen in the divorce context. All right, so we kept going through, and hopefully we saw all the practical implications. We then turned our attention last class to Chapter 6, dealing with stock dividends and 306 stock. And generally, Adele, if you get issued stock from a corporation, is that taxable or not taxable? And your authority is? Say again? Kenneth, do you know? What code section applies to say it's not taxable? Marlon? 305 what? 305A, right? And Ryan, next to 305A, what code section do you have? 307, right? So we looked at that, and we saw that often stock dividends, because if Allie has one or two pieces of paper, she's not feeling any richer with one or two. But we did say, and we did see, that Code Section 305 has its general rule of distributions of stock, but there are a plethora of exceptions spelled out in 305B. 305B1, B2, B3, B4, B5. Now, I probably forgot to mention that reading the examples and the regulations would be important for this, but just in case I forgot, that's my way of saying a joke, which is, now you know I'm not a stand-up comedian. I think I said several occasions that you really should look at the examples, right, in the regulations, because it's very hard to come up with exam questions or other questions that go too far afield from the questions or the examples in the regulations. So do yourself a favor, if you haven't already, go through and examine the examples in the regulations, right? Because those are going to be very useful. And if you do so, you'll see the authors have not gone too far afield from the examples that are in the regulations in crafting your own problems. Now, we learned that even the issuance of preferred stock is not subject to tax when a corporation typically issues it, but it may be, depending on circumstances. Some of you mentioned this, 306 stock, okay, which we're going to revisit in a moment because there's special tax consequences associated with Code Section 306 stock. Our job tonight, guys, is to finish the chapter 6, dealing with 305 and 306, and then to finish Chapter 7, begin and finish in the same breath, dealing with corporate liquidations. That's our charge for tonight. Any questions or anything else that we want to talk about? Now, Jared owes us a review. He said he would keep it under 30 minutes. Yeah, I got an email from him. So, Jared, 30 or 3 minutes, one or the other. How was the movie?
The movie was not very good.
You did not like it?
First off, I read the book.
By the way, if people don't remember, he's talking about World War Z.
Sorry. I read the book, which is really quite excellent, even if you're not really into zombies.
There's many people here who will not admit it, but they're into zombies. But
it's a very interesting book that could really be changed if you replace the word zombie with some sort of plague.
Okay.
And it talks about how the world would react to something that would kill 90% of the population. Anyway, the movie is really nothing like the book. They just kind of used the title. And it's a zombie movie that's not really gory and it's not really too deep on a storyline. It's just kind of, it's not very...
Didn't do it for you.
And the 3D special effects were completely pointless. Like, it wasn't even one of those movies where, things are coming at your head and you have to dodge in that cheesy way. It was just...
Not good. Okay. And Brad Pitt didn't do it for you.
No, although I typically do like Brad Pitt movies, this one just not really.
Okay. And I think they had scenes in North Korea and Israel where the zombies couldn't climb the walls of either country. That was...
Yeah, there's it talks about the different countries and how they kind of dealt with it, and it didn't seem to work very well.
Okay. How did the U.S. fare? Got a self-interest here.
Not very well.
Damn it. Any other movies, guys? Nothing? Okay, The End. Some people saw it. What did you think? You know the movie that looks promising as dumb summer humor, but the one with Sandra Bullock coming out? What's it called? The Heat. But it looks like one of those movies, like a train wreck you probably shouldn't see, but you'll want to see it anyway kind of thing. All right, and I usually don't say what I think are good or bad politically. Maybe you think I do, but you know what happened today, and I thought it was a good news for, I'll put my cards out there. So the Supreme Court voted 5-4, and this will change. This was all dealt with the state tax. Those who know that Code Section 2056 permits an estate tax deduction if you're married to your surviving spouse, but if you're part of a gay marriage, they were denied the deduction, and the Supreme Court ruled 5-4 with Anthony Kennedy being the typical swing vote that he is, in favor of saying that that doesn't pass constitutional muster. So the estate planning world, for at least 10% of the population, may be fundamentally changed. So it's an interesting decision. Rafa? I think so. There's going to be a lot of commentary on it. In other words, in New Jersey, where we don't have gay marriage, I don't think you could qualify for the marital deduction, but you would have to be married in a state that recognizes gay marriage. I don't know. Those are good questions. And not only good questions, it seems to me you want to have a uniform system. I don't know how that's going to work. Interesting day. Anything else? Any other commentary? No? All right. So you guys, after this weekend, we're all going to get together. When I say we, most of us, Saturday, right after the exam, give me 1 hour, 60 minutes. But we're going to meet at Kilkenny's, and it should be fun. And let's see how that works out, okay? So I'll send you directions. It's 500 feet from the front door, okay? All right. So let's just remind ourselves where we are. We're on page 304. We talked about Code Section 306. Code Section 306 is stock that is going to carry a taint with it, whether there's a sale or a redemption of it. There are consequences associated with it. It applies to preferred stock, not to common stock, okay? You cannot have 306 common stock. It can only be preferred stock. And we discussed the mechanics on page 308, that when it's a sale, there's a look-back rule. And when there's a redemption, you look at the current available earnings and profits. And the notion is, the strategy was that taxpayers might, there's a Chamberlain case that said that if you have common stock, and now we issue preferred stock on your common stock, that's tax-free. But taxpayers might then sell their preferred stock to a third-party facilitator, command capital gains, and then very soon thereafter have that preferred stock redeemed, and essentially be able to get cash out of a corporation at the then preferable capital gains rates, and be able to also take advantage of whatever tax basis they had. Congress was not enamored with the outcome of the Chamberlain case, so it put Code Section 306 into effect. When it did so, it didn't cause immediate taxation. Congress was patient and said, we'll look at it depending on what happens in terms of if you sell the stock or you have it subsequently redeemed. All right? And we left off, I believe, on the problems on page 316, but again, correct me if I'm wrong. What I like to do is go through these problems and make sure we have sufficient time to make sure we can cover all of Chapter 7. All right? So, if you remember, we looked at problem 1, where we had a corporation distributed non-convertible, non-voting preferred stock worth $1,000 to each of two unrelated shareholders, J and B, and the A stock was owned by each. The shareholders had a $2,000 basis prior to the distribution and a value of $3,000 immediately thereafter. At the time of the distribution, A had $2,000 of EMP. In year 3, several years later, it had $3,000. We talked about the tax effects, at least in problem 1A, tax effects to Jason, Vera, and the corporation on the distribution of the preferred stock. And for your notes, hopefully you have in question A that it was not subject to tax, right? No tax. Is qualified for no tax, 305A. Right, Marlon? 305A and, of course, 307 applied. And we went through a computation where we took we looked at the ratio of value times the existing basis. Oops. And that was meant to be a P, not a C. And we said that the corporation had no gain or loss, and that the E&P would not be adjusted. So for your notes, everyone has that? That the shareholders have no income, the corporation has no gain or loss, and the earnings and profits are not adjusted. Everyone can handle this if they saw it on an exam, right? Irma, you got this? You okay? Okay, want to make sure. Question B. What result to V and A if Vera sells her preferred stock to Carl, an unrelated party, for $1,000 in year 3? So, Fanta, are we going to look back or look forward? What would she like to report, Vera? What would she? I'm sorry. Oh, before we even get there, I apologize. What would Vera like to report here? Capital gain, right? Under code section what? 1001, right? $1,000 amount realized, basis 500. But we have to be circumspect. Code section 306 is here. So what happens under code section 306, Fanta? We looking back or looking forward? You said it before. Okay, why? Right, and the code specifically says in this kind of circumstance you look back with respect to a sale and you take the pro rata earnings and profits of that time period. How much were the earnings and profits at that time, the pro rata amount? Earnings and profits was $2,000. She was a 50% shareholder. The pro rata amount of that would be 50% or $1,000, right? So, what happens here? What would Vera have to report? Carolina? Just say it loudly because you're... Of? Are you going to get full credit if you put 1,000? I'm not going to give partial credit. So are you going to get it right or wrong? Because you're going to leave out what part, Kevin? Kevin? Edwin? Say again? You have to tell me the character, right? The year ordinary, but to say 1,000 ordinary, you would have been safe at home. Okay, $1,000 of ordinary income. What happens to Fatima, Israel? What happens to her basis in the preferred stock? She had a $500 basis, and now she has to report $1,000 of ordinary income. What happens to this $500 basis? Go ahead, Fanta. You were going to say? She doesn't own that piece of paper anymore. So what happens to this $500 basis? It rolls back into the common. Okay, what's my authority? I'm glad you asked. 306-1B2. I'll repeat, 306-1B2, example 2. And Matt, because you're probably wondering what happens to the earnings and profits here, nothing. Big zero. The authority for that is 306-1B1. The earnings and profits of the corporation should remain intact. Go ahead, Chief.
So if the evaluation of the example is such that if you sell a part of your preferred stock, then you roll back the basis to just of the preferred stock
if you have no preferred, then roll it too. Yeah. Okay? Question C. Same as B, except that Vera sells her preferred stock to Carl, this third party, for $1,750. So go ahead, Alice. So that's question 1A. We apply code section 307, and we divvied up the $2,000 tax basis she had on the proportion of fair market value, right? Okay? You remember? And if we sell it, in this case, Guillermo, Larry, we sell it for $1,750, what happens? What is she going to report? How about other Larry? Howard? Just, is that your final answer? Is that it? Keep going. Okay, just say it loudly, because say I have $1,000 of ordinary income, essentially $500 basis recovery, and $250 worth of capital gain. Okay, and that makes sense. And this is not under 301C1, 2, and 3, but under 306A1A. Your authority here is code section 306A1A, which says the entire amount shall be treated as ordinary income. And then if you keep reading, it says this subparagraph shall not apply to the extent that the amount realized, which is $1,750, exceeds such stock's rateable share of the amount that would have been a dividend, which is essentially $1,000. So it's carving out 750 doesn't of the 17. It starts off that all 1750 will be treated as ordinary income. Then it says that it will not apply to 750 of that, and the regulations make clear under 706 that the outcome here will produce a $250 capital gain. So let me just see if 306A1 capital letter A. Okay? And if you look in your regulations at 306-1B2, and you look at the examples here, example 1, 2, and 3, they have virtually the identical problem. Okay? This is example 1. 306-1B2, example 1. Question D. Same as B, except that A had no earnings or profits at the time of the distribution of the preferred stock. Okay? Same as B, where she sells it for $1,000. What would happen if 3 years later she sells it for $1,000, but at the time of the distribution there was no earnings and profits? Lee, in that case, what would happen? You tell me. So what's your answer? What's your authority? Let me put it that way. It's always a good question to ask. Lee, do you know? I'm not saying you're wrong, Fatima. It's a... Well, does 306 apply in this context, guys? No. What's our authority for that? 306C2, right? Code section 306C2 is, first of all, 306C says what is 306 stock. 306C2 says exception where no earnings and profits, because the government doesn't have a concern that the taxpayer is playing a game here, right, guys? So, in this context, Fatima, you might have produced the right answer, but you got to say, hey, this is not 306 stock, and Fanta, like you were saying before, here the taxpayer can get the result she wanted, which is she's selling it for $1,000. Her basis is $500. Code section 1001 applies, and the gain produced here would be $500, right? So, guys, obviously one of the first things you have to do is make sure you know if you have 306 stock.
So in terms of answer, the answer would be the same as C, where 1,000 would be ordinary income, 500 would be basis recovery.
No. In this question, they sold it for $1,000. Look at the question again. And here we have the taxpayer where we just ultimately have code section 1001 applied because 306 does not apply to this fact pattern. Okay?
What happens to A? Is it still no effect?
No effect. It's just a normal sale. Normal sales have no bearing on earnings and profits. Okay? $500 capital gain. Yes. Okay. Okay. Everyone ready? Okay. What result if Jason gives his preferred stock to his grandson? That's a nice grandpa. Claude. And Claude later sells the stock for $1,000. Okay, let's just stick with that fact pattern. So grandpa is giving grandson stock for $1,000, and it's hard for me to resist. Does grandson have any income? Code section 102, and what's the grandson's basis in the shares? 1015, producing a basis of how much? 500, right, Kevin? Okay. So, Christy or Christina, gain or loss here when grandson Claude sells the shares, and if so, tell me more. Remember, 1015 is simply basis. It doesn't say anything further. There's a carryover basis.
But it also carries the 306.
Christina agreed. Does it carry the 306 taint? Now, 1015 doesn't talk of 306 at all, right? Everyone agree? If you look at, I promise, you may not trust me, but trust me. If you look at code section 1015, it does not cross-reference 306, right? So, and Christy's concerned, and rightfully so, that when we've spoken about 1245, you can't get rid of that taint. Everyone agree that if you have 1245 recapture, you can't get rid of the taint. Agreed? And Claude is getting this tainted stock, but what is Claude doing? Selling it. And when Claude sells it, he's terminating Claude's interest, right? Now, is there any exceptions to 306 if you terminate your interest? He's not dead. Hold on. You said 1014, I thought, right?
No, scratch that. I'm saying 1014 doesn't carry the 306.
Well, 1014 does, and I agree with you, but let's just stick with people who are all alive. No zombies, right, Jared? No zombies yet, all right? Brad might have a different angle on this, but everyone's still alive, Christy, okay? So the question is, you give this to your grandchild. You guys are too young to think this way, but picture you had grandchildren, and now your grandchild sells it. He or she has terminated their interest in it. And let's just turn to Code Section 306B talks about exceptions, right? And generally 306B1 talks about a termination of a shareholder's interest. And if it's not a redemption, that's another way of saying sale. So 306B1 capital letter A says if it's not a redemption, which is a sale, if the disposition is not a redemption and is not directly or indirectly to a person, the ownership of whose stock would, under Code Section 318, be attributable to the shareholder, we'll talk in a moment, and terminates the entire interest of the shareholder in the corporation. And for this purpose, Code Section 318 shall apply. This will qualify, essentially it's saying this will qualify for an exception to 306. So let's just think about that for a second. If you terminate your whole interest in the corporate enterprise, everyone agree? You don't have to worry about the 306. Agreed? But, damn it, we got to deal with Code Section 318, right? Congress wasn't born yesterday. So the word termination means you can't have any stock attributed to you, right, Irma? So even if you don't own any shares in your name, shares of your family members could be attributed to you. And if you did, if that does apply, then you're out of luck. Are you out of luck? Who's that? When? But are you related to your grandpa? Hold on. But grandpa's giving you the preferred stock, right? And then you're selling you the preferred stock. So are you out of luck, Christy? Or why are you out of luck? So grandpa still has the interest. But are you out of luck?
No, because you can leave family.
No, but are you out of luck? And why not? Because you don't own grandpa's shares. Grandpa owns your shares, but there's no attribution the other way. Okay? So you have truly terminated your interest in this enterprise. Because grandchild has sold grandchild shares. Okay? This works, surprisingly. Because grandchild has terminated his interest, right? And 318 doesn't apply in this context. Because grandpa's shares aren't attributed to grandchild's shares. If it was the other way, don't take you'd be screwed. Okay? Everyone see how 318 is working here?
Doesn't the grandfather owns the shares of the grandchildren?
But the grandchild isn't deemed to own the grandfather's shares.
So once the grandfather gifted the share to grandchildren.
So once the grandchild sold his shares, he owned stock, but now he went to zero. He terminated his complete interest, even under the 318 rules. Right, JP? So this would work where Fanta would produce $500 worth of capital gain because it's not going to be, he's going to terminate his whole interest in it. So we don't have to worry about the 306 taint. Yep. Now, Jared, this one's waiting for you because if we were dealing with death, right, and zombies, what would happen in this case? In the movie, did they discuss what would happen if the zombies got 306 stock and they subsequently tried to sell it?
It didn't go that deep.
Didn't? Damn it. Well, you take it the next level.
It would be.
We know Code Section 1014 applies.
The basis gets stepped up to fair market value.
And with the 306 taint carry with it. What do you think? Topeka? No. What's your authority? Well, 1014 again just says base. Doyle, do you know? Is there regulation as in 306-3E that says essentially the regulation says that if someone is willing to die for the cause, guess what? You don't have to worry about 306 anymore if you inherit the stock, okay? 306-3E. It says the very last sentence of that regulation. Section 306 stock ceases to be classified that the basis of such stock is determined by reference to fair market value in the date of the decedent's death or the optional valuation date under Code Section 1014. Translated, it doesn't apply. Again, my authority 306-3E. Code Section 1014, guys, you wouldn't cite to it because Code Section 1014 doesn't say anything about 306. You need better authority than that. We're good? Everyone, your notes, no 306T. Question F. Let's for your notes skip question F. There's a Code Section 170E that talks about contributions of stock to a charity. It gets more complex than we need to, so don't look for it on the exam. Let's skip it for our purposes. Question G. What if Jason and A, in year 3 of the corporation, redeems half of Jason's common stock for $5,000 and all of his preferred stock for $1,500? And let's compare and contrast that G and H, okay? So look at question H simultaneously. Same as G above, except that the corporate bylaws require unanimous shareholder consent for the corporate action, and the bylaws may be amended only by the concurrence of more than 75% of the shareholders. Okay, so question G, and just let's remember the fact pattern what we have going on here. We have two unrelated shareholders, J and V, who own this corporation, if you recall, A. And we're going to have Jason's half of his common stock. I forget if they say numerically how many shares he has. Each one has. But what's going to happen numerically if they're 50-50 shareholders? Jason's going to go down to what, guys? 25% or what percentage? How many shares? So doesn't it go? Does it go down to? Year 3. Okay, but what percent owner does he become? Okay, 1/3. That's what. Okay. Now we're on the same wave. Everyone understand? Jason goes from a 50-50 to a 1/3 shareholder. Agreed? Because now we know to change the denominator. There's 75 shares outstanding, right? Okay. And with respect to year 3, the corporation redeems half the common for $5,000 and all of his preferred. So what would Jason like here? We know the answer is that, well, let's just take his common stock. What's his amount realized? 5,000. Everyone agree? And what basis does he have in his shares? That one? 750, right? Everyone agree? Where do we get 750? He sold 1/2 of the common stock, right? Everyone agree with respect to the common? Now, is this a true redemption or is this a distribution in this case? True redemption or distribution in this case? Angie? Is this true redemption? I'm sorry? Why? Janine, do you agree? You say it louder? Why? going from 50% down to 33%. He owns less than 80% of what he owned before. It should qualify under 302B2. So that should qualify for exchange treatment. Now, what about the $1,500 he receives for all of his preferred stock? He'd like to report $1,000 capital gain. Kenny. What earnings and profits do we look at? Do we look back or look at the current earnings and profits? Okay, redemption, we now can look at the current earnings and profits. Are there a lot of current earnings and profits in year 3? There's 3,000, right? Everyone agree? This company is flush with earnings and profits. It's been doing quite well. Now, what does that mean? Under 306, if this is 306 stock, which it is, right? Everyone agree? This is 306 stock. And again, if you recall from our last class, the case that immediately precedes this, fire-oved, beginning on page 310. Remember that taxpayer sold a portion of his underlying common stock, and the court was still unwilling to say, gee, as to you terminated half your interest in the common stock, you can at least qualify half your preferred stock for normal exchange treatment. It said all the preferred stock remain tainted. So that being the case, if you have your preferred stock, 306 stock redeemed, all right, and there's plenty of earnings and profits, what happens to your preferred stock or the money that you realize? How is that $1,500 going to be treated? Ordinary income. So we had